This is Las Vegas Real Estate Now, where we bring you the 3 E's: educate, empower, and engage. I'm your host, Harvey Blankfeld, along with our co-host, Shelley Brown, and we've been selling homes here in Southern Nevada since 1988. Shelley and I are also very proud to be part of the Real Estate Radio Network. That is a national network of local real estate professionals delivering timely, balanced truths about local market conditions. And with us in studio now, we have Kari Phillips from Southern Fidelity Mortgage. She's their top loan officer, and she's been doing it for 18 years. She has a bachelor's in marketing and an MBA. Welcome back, Kari.
Thanks for having me again.
So glad to have you back. One of the topics we wanted to touch on today, and I mentioned it earlier when I did the open of the show, was people who had foreclosures, people who had short sales, and these things in years gone by. Many of them at this stage are eligible to purchase again. What kind of timeline should they be thinking about?
Well, it depends on the program they're going to be doing. If they're a VA client, we need to wait 2 years past their foreclosure date, and not when they think the foreclosure started. You know, I've had it where a client says, "Well, I started the foreclosure in 2008," and I say, "Well, it just showed up on county records in 2015, so we can't." It takes sometimes a long time for the bank's procedures to go through.
For many of our clients that we talk to about short sale, we discuss the idea of when the clock starts ticking. And it's a big deal when you're considering short sale or you're up against a foreclosure, because the clock doesn't start ticking until it records, until it actually happens, until the final foreclosure is done and the house now belongs to the bank. That's when the clock starts ticking. And the banks, quite honestly, in a lot of cases, take their sweet old time doing it.
Absolutely.
Some of them haven't even done it yet.
Exactly. Many
you
of
may
them.
have not lived there 5 or 6 years, but guess what?
It's still not done.
It's still in your name.
There's also this issue, and I want to maybe talk a little bit about that, called compensating factors.
Well, you know, we talked a little. It sounds like it's been a little negative in this talk. You know, foreclosures, you have to wait and whatever. But the nice thing is what I have found, that guidelines have gotten a little bit more forgiving. And, for example, I have a client that he has a 56.99% debt to income ratio. What that means is that's really high. Okay, it just means your monthly debt divided by your income is on the high end. Lenders will say, you know what, I want the debt paid, or I want something to make us feel better about this new mortgage payment that this person is going in. Well, I was able to talk to the underwriter and say, hey, listen, he's got a roommate moving in who has a job. Here's the roommate's pay stub. They're going to end up 6 months reserves in the bank, so that means that they're going to be left in their bank account, in his bank account, with 6 months of mortgage payments. So that he's got a little bit of a cushion. It's not like he's bringing down his assets to zero. And this particular program did not require reserves, but I was able to say, here's a compensating factor. And then there was he was going to put 5% down instead of the 3.5% required for FHA financing. He had to do FHA financing, but he put a little bit more down payment. Because of those compensating factors, the underwriter said, you know what? Fine, I'm good, approved. So in that light, underwriters are looking at this as, let's leave some wiggle room here. Show me, make up for some of this risk with some positive things in your file, and I'm going to approve this loan.
You've been listening to Las Vegas Real Estate Now with hosts Harvey Blankfeld and Shelley Brown. Please tune in every Saturday at 11 a.m. right here on News Talk 720 KDWN.